everyone. We're going to get started. Welcome to the joint chamber meeting. There's a lot of Forest Park people here. There's also people from Evendale and Woodlawn. So welcome everyone to Forest Park, the Forest Park Library, our beautiful new facility from Cincinnati, Hamilton County Public Libraries. It's a great place to meet, and thank you to Hammond's Catering for lunch today. Hope everybody enjoyed it. It was, I think the vegetables are usually my favorite, and we all don't always eat vegetables, but they make them pretty good. So welcome. We are trying to get some joint chamber meetings together with, different areas to try and get everybody across the board to, network a little bit more opportunities and give you some great information. So I want to thank Wayne Bradshaw with Stockyards Bank for, he's also from Evendale, and he is the Evendale branch manager of the Evendale branch of Stockyards Bank. And so he helped us to get this together, and so thank you all for joining in. And so I'm going to introduce our speaker. It is David Brooks. He is a investment advisor for the region and has been in this industry for over 30 years. So that means he started at 5. He was a child genius. Just like me, we all started working when we were like 1, because there's absolutely no way that we are this old. Been in this business that long, but no. But we are very, very pleased to have him here today to give us some wonderful information on the state of the economy and maybe what we can look forward to in 2026. And so without further ado, I'm going to introduce David.
Well, thank you all for letting me come in today. I want to thank everybody for setting this up. It's a very nice facility. I feel honored to be here today. I'm going to try to talk about this in the vein of thought of helping you individually too with your own investments. That's something that I've been doing for a very long time, and I have a lot of passion about how you should invest or not invest, and you might pick up an idea or two here today. But I also want to talk about the economy, what's going on. It's a very I guess I'll call it tumultuous time in our country, and therefore, the economy can be affected by that. So I want to explain that a little bit and how to look at that a little bit. So as I go through this, feel free to raise your hand if you have a question. I like interaction, so don't hesitate. And then at the end, I'll try to answer any questions you have. Again, I've done this for a very long time, so there's no proven answers to anything, but I can give you some insight as to how to maybe approach things. So without further ado, I'll get started here. Like I said, I'll talk for about 20-25 minutes, and then we can have some questions if you'd like. So, okay, so this first slide, we call it our market scorecard. Now I'm going to update the numbers at the bottom, but what we have and what you'll see there at the very top is what's called an ongoing bull market. What is a bull market? A bull market is something that goes up. You can have a bull market in the stock market. You can have a bull market in gold. You can have a bull market in anything that is, traded. And a bull market means it's going up in value. A bear market means it's going down in value. And we have a bull market because if you follow the stock market, it has been going up for quite a long time. And a lot of people are saying, well, how is it going up? We have all these things going on in our society. There's a lot of political division. We've had these tariffs introduced, a lot going on, right? And what I always try to remind everyone is that the stock market is not an indication of the social situation of a country. And that is a very powerful comment that a lot of our clients forget. Because in a politically charged environment like we have in our country, people will make investment decisions based on political beliefs. And that's a boo-boo, because the stock market does not reflect societal challenges. It's hard to kind of understand that, but if you think back on a lot of tough times in the country historically, I'm going back decades, the 60s were a tumultuous time, bad things happened, the stock market kept going. The stock market is a function of money and corporate earnings, and companies can make money even when a society is having challenges. So that's very important to understand, because a lot of times somebody makes a decision based on what they think of the political structure, and whether it's a Republican or a Democrat or whatever you want to classify a politician, the stock market can do okay because it cannot be directly affected. And that's something that it gets lost on a lot of people. So we're in this very resilient situation right now. We had these tariffs come out earlier in the year, you may recall. And there was a lot of concern about that. And what we've learned is that companies are creative, okay? Just think of a company that you might go to. Could be something like Target, Costco, maybe it's a car dealership. And these companies, they figure out a way to deal with the tariffs. And this is what we've learned this year. These tariffs have come out. Everybody thought we were going to have a major problem economically. And lo and behold, the companies figured out a way to either pass on the cost or cut a little bit here or lay off this person there, do something so that they could still make money. And the stock market saw that and has obviously gone up in value. So the tariffs have not caused the problems that many people thought they would. So a very resilient economic situation we have right now. We also have this artificial intelligence thing going on in our country. You've probably heard about it in the news, AI, as they call it. This is a big thing. Its impact is hard to measure, but the companies that deal with artificial intelligence are making a ton of money. Hand over fist, they're just printing money for themselves. And it's very important to understand that when you have an industry like that, and you're one of the countries in the world, which we are, that is leader in that, it kind of lifts all boats, as it were, with a higher tide. And so that's been lifting the stock market. The third item there in the upper left-hand corner, again, that's where I'm looking, is the pro-cyclical fiscal deficit. And that's just a bunch of fancy words to say that the current government, meaning the current administration, is spending more money than we bring in terms of tax revenue. And you say, well, how in the world is that good? Well, someday we may need to pay the piper. But right now, the stock market likes it when we're spending money. Deficit spending, which really began back in 2008 when there was the great financial crisis. If you remember 2008, there was that big crash. All the banks almost failed. It was a really bad situation. At that point, the government and the Federal Reserve started to, people use the term print money. Let's just go with that for now. It's more complicated than that. But this printing money and just sending it out and deficit spending, it works. It lifts the economy. Someday it may matter. Everybody always says, well, when's it all going to end? I'm like, well, you tell me, right? I mean, it's like this past summer, it was 100 degrees every day. I had no idea it was going to end, and finally it broke. So someday that'll be a problem, but right now, deficit spending, whether it's a Republican or a Democrat in the White House, doesn't matter. As long as you're spending more money than you're bringing in, the stock market likes it. It's the way it's been for a long time. So just because we're talking about it doesn't mean that it's going to all of a sudden be a problem. Because ultimately, all that spending is going to drive companies to make more money. And finally, the fourth item up there, the Fed is in an easing mode. And what am I saying when I say the Fed? The Federal Reserve, controls the money supply of our country. And they are one of the most powerful institutions that's not really talked about. We talk about politicians a lot, this and that, but the Federal Reserve, which was begun back in early 1900s, they are very powerful. And when they lower interest rates, and you'll hear this occasionally, oh, the Fed lowered rates today. When they lower interest rates, if you're borrowing money, if you come into a bank like Stockyards or PNC or Fifth Third, and you get a loan, you pay less interest if the rates are lower. So when the Fed is in an easing mode, they're going to cut rates, you never want to bet against the Fed. The Fed is very powerful. The stock market will go up. So we're in a very, very, quote-unquote, inflationary shift that's taking place. And I'm going to talk about that a little bit more here. I want to jump down to the third bullet point. If your own investments, like if you have a 401k or an IRA or something that you're saving for your retirement, you want to put some money in international stocks, okay? These numbers down here at the bottom, the international stock market is beating the United States stock market for the first time in like 20 years this year. And you say, well, why is that? Whether you agree or not with the current political administration, they are forcing other countries to carry their own weight. The current administration is saying, look, we're not going to give you as much money, we're not going to help NATO, we're not going to, again, I'm not judging, I'm just saying they're telling these other countries that you got to care for yourself. So countries like Germany, England, India, Australia, all of these countries are all of a sudden looking at each other saying, well, if the United States isn't going to give us money, we got to do it ourselves. And they're going to issue debt, right? They're going to, borrow money. And there's that cyclical deficit I talked about. We borrow money, don't we, right? Spend more than we have. Well, these countries are going to all of a sudden do it. And guess what? The stock market loves that. So the international stock market is up 25%. We are up 15%. So if you don't have any money of your own invested internationally, you want to do that, okay? Because we think this is a change. Again, not judging, but the current administration is changing the world order. And if these other countries are going to have to invest in their own country, the stock market's going to like that. And therefore, international stocks should be bought. And then the last thing I'm going to add on here that's not shown is gold. I'm going to talk a little bit about gold here in a little while. Gold is up 50%. If you bought gold on January 1st, say you put $1,000 in gold, you now have $1,500. That's 50% in 9 months. That is a lot, and we're going to talk about that. So let's go to the next slide. So what is the macro backdrop? I don't know if anyone watches. Our CIO put this together, but Curb Your Enthusiasm. This is the gentleman, if you've seen that TV show. And what basically our chief investment officer said is that we need to curb our enthusiasm a little bit on how great things are in terms of the stock market. So the stock market is doing very well. And so he touched on a couple things. We talked about fiscal policy. I'm going to explain that. Again, we're spending more money than we have, and the market likes that. Private sector wealth. So this is it's a sad statistic, but it's one that needs to be heard. The top 10% of our society, spends more money than the bottom 40% combined. So I try to remind people that, my daughter's involved in an industry that's affecting by this and tries to help a lot of people that are in need. The poor are in a tough spot right now, but the stock market doesn't care. The stock market cares about the wealthy and what they're doing. And I hate to say that, but it's the way it is. And as an investor, if you want to make money, you need to remember that. Because this is about making money. If you're an investor, which is what I help people do, you want to make money. So you need to look at what the wealthy are doing. What the wealthy are doing is what drives the stock market. And the private sector wealth is positive. It's volatile, but people that have money have a lot more money now than they had before. Okay? Credit. Right now, if you go into a bank, you can get a loan pretty easily. Not quite as easy as during COVID, when we had these government programs where we were just handing money out, hand over fist, but we're still lending money quite a bit. And jobs and wages. Okay, so jobs and wages, that one's a little tricky. And I've got a slide dedicated to that, so let's jump ahead and look at some of these. First thing I want to talk about is government deficit spending. You're like, okay, what is this squiggly chart here? Okay, and by the way, at the end of the presentation, we're going to hand out a copy of this if you want to look at it. But you'll see this squiggly line going down, right, from left to right. Down means we're spending more money than we have. Okay. You're like, again, that doesn't sound good. Guess what? Stock market loves it. And it's important on the very right, you'll see the squiggly line. The current administration, even though they are making some changes with the federal workforce, and there's a lot of news going on about companies and the shutdown and laying off this worker and that worker, at the end of the day, even though the current government is trying to save a little bit of money, they are spending a lot of money. The bill that was passed, I think in the media was called the One Big Beautiful Bill. People on the other side of the aisle call it the One Big Ugly Bill. It's a very political bill, but the point is that bill is spending a lot of money. It's giving back money to us through taxes, and we spend it, and we are spending a lot of money, but we're not getting it in terms of tax revenue. So again, it's that deficit spending thing is continuing. So that's why you see that going down. That is actually bullish for the stock market for now, okay? So that's something that is pro-stock market go higher, okay? And this is the wealth effect. So one of the things that occurred after COVID, so that gray line in the middle of the screen, okay, this is the wage growth, okay? If you can see it on the left, it says 3 to 4%. So coming into COVID, if you start at the left, basically people got somewhere between 2, 3, 4% raise each year. Okay, that was typical, right? You go into your review, here's 2%, have a nice day. You're like, oh, great, wonderful. And then COVID hit, and everything shut down, okay, and everybody just froze. Nothing happened. And then all of a sudden, we started to open up. But people are like, well, I don't want to go back to work. Well, you got to pay me more money. Well, I don't want to go back to work. Well, you get pay me. So finally what happened is the companies that wanted people to come back said, well, we'll pay you 10%. We'll pay you 8%. We'll pay you whatever. And all of a sudden, everybody got these raises. And that's what is that line going up there. And then recently, it's been coming back down. But companies who have good employees, they're having to pay them more money to keep them. They're having to pay them 3%, 4%, 5%, 6% raises to keep them happy, right? So there's a competitive environment. This helps people have more money. And therefore, that is something that is taking place. Now, I understand every industry is different, right? So, there are exceptions to this. But generally speaking, COVID has led to people getting more money if they are willing to work, okay? So this is a credit and financial conditions. It's a little bit busy of a chart, but I'll just dumb it down to say that when you look at the chart, it goes down, and then it goes way up, and then it goes to the side, right? When you see it go down, that's easy credit. You could go in, get a loan, have the money, here you go, no questions asked. And then when the line goes up, the banker is like, well, do you have enough money? Do you have a job? What's your collateral like? Are you a good person? What's your credit score? Yada, yada, yada. And then you'll see it taper down. What happened is after COVID on the left, you'll see that's 21, 22. After COVID, we were lending a lot of money because the government was asking us to stimulate and lend money, PPP loans and all this stuff. Then all of a sudden, inflation developed, interest rates started going up. The Fed started raising rates. You might remember that. Rates were being raised and higher and higher and higher, and we started to contract lending a little bit. And then lately, we've been starting to lend out more. So we're kind of in the middle. If you look, you gotta go all the way to the left, all the way to the right. We're almost like we're back to COVID times, but not quite that lenient. So pretty good availability of credit. So it's a complicated chart, but it basically shows you that things are easing right now. So if you want a loan, go into a bank, and they'll probably get you one because we're trying to get more money out there into the system. Okay, so let's talk about jobs and wages. This is a very, I think, a good way to look at jobs. So at the top, you'll see two charts, right? The good says not much firing. At the bottom, it says the bad, not much hiring. So the good is, because that chart, that squiggly line that was way up there and then came down, okay? If you look at that, you'll see that goes back basically to COVID, okay? And during COVID, either people were sent home or let go or whatever, and firing was pretty bad. They might have called it something, but people weren't working. And then as we came out of COVID, we stopped firing people, and now we just kind of going along the line, right, along the bottom. So we're not really firing a lot of people. Now, yes, you'll hear in the media, so-and-so laid off somebody or so-and-so laid off somebody, but it's not mass firing, okay, like it was during COVID. So that's the good. Typically, people aren't being fired. The bad is we're not hiring many people. So that's the bottom chart. And you'll notice after COVID, we were down low, and then all of a sudden it spiked there like an EKG on a chart or something, went way up, because all of a sudden companies like, oh, wow, everybody's coming out of their house again, and COVID's going away, we need to hire everybody. And then it's tapered down. And now we're in this place all the way to the right where companies are hiring, but only if they really need somebody. So we're in this weird balance here where nobody's being fired, but nobody's being hired. And so this is like, it's a kind of like a seesaw. And this is really going to be the key determinant as to how the Federal Reserve goes forward. Do they cut interest rates more if the labor market slows down, if people start getting fired, or if they start hiring a lot of people, the Fed may not cut as much. The one curveball in all of this is while the government is shut down, we don't get economic data. So we're in this kind of weird, hey, what do you think is going on out there? Because we're not getting any data from the government. So while the government is shut down, we don't know what's going on. And so the stock market's kind of like, not so sure about that. So we'll see how long the shutdown goes on, but interesting times. So is this a recession? Well, obviously the answer is no. There was a lot of talk, and the reason this slide is up here is earlier in the year when the tariffs came out, okay, everybody thought for sure we were going to have this horrible life-ending recession and we were all going to lose our jobs. And what you'll notice, kind of on the left bottom, you see a little arrow pointing down. Right there around April, okay, sales activity when the tariffs came out dropped down to almost zero. That's that blue arrow. But then it popped right back up, okay? And then it's come down a little bit. This bar to the right, the orange bar, that's the most recent data, is still showing you that activity is going on. So as much as these tariffs have occurred, people are still buying things, they're still buying cars, they're still buying houses, maybe not at quite as high of a rate, but they're still active. So that brings us to the Federal Reserve. So this chart is very complicated, but what I will tell you is the Federal Reserve is expected to cut interest rates, okay? The Federal Reserve is a part of the government that tries to stay independent, and they control interest rates, okay? And this chart, I'm not going to bore you with how to read it, but it's basically saying that the Federal Reserve is expected to cut interest rates 2 to 3 more times between now and next Easter, okay, meaning the spring. That would cause you to be able to borrow money at a lower interest rate, right? It's one of the reasons why the current administration is saying cut interest rates, stimulate the economy, but the Federal Reserve that tries to stay politically independent is saying, well, we don't want to cut interest rates too much because that can cause inflation. And then all of a sudden things become more and more expensive. And you don't want inflation. Inflation is bad for countries because it causes things to, cost a lot more, and everybody doesn't like that. So, but the current thought is that the Fed will cut rates, and that's what this chart is showing. They meet near Halloween later this month, and they think they're going to cut rates again. But they've told us that they're going to wait for the economic data. Well, right now we're not getting economic data because the government's shut down. So we're in this weird kind of limbo. So we'll see how this plays out. So this next one gets to the stock market, and this I did want to spend a little time on this chart. So equity evaluations, what in the world does equity valuations mean? Equity valuations, when I say the word equity, that's a stock, okay? A stock is like in Procter & Gamble, Microsoft, Coca-Cola. So equity valuations, stock market evaluations are somewhat elevated, okay? But everybody's like, well, do you think we're going to have a crash? And what I explain to people is that the stock market's kind of expensive, but it's not out of control, okay? There's some measurements. They're called price to earnings ratios. And only if those get really extended does the stock market really run the risk of crashing. We're not at those levels. So we think the stock market can go higher. Now, this bottom right chart shows you that some of the companies that have done the best are those kind of companies you might expect, like Amazon, NVIDIA, which makes chips that deal with AI, Google, which, I used Google Maps to get here, and somehow it got me in the back way, so I was happy with Google this morning when I came in. So these companies are making a lot of money, but they're also representing a large part of the stock market. If you don't have money, your own money, in artificial intelligence, you need to do that. that is something that is going to continue to go up. Whether you think it's good or not, or someday we're all going to die to Terminators, make your money while you can, because AI is not going away, and it's just getting started. We're in the early innings of the AI boom. That's not going to end anytime soon. And the other thing I want to touch on here is I've had a lot of people bring up 1929. It was about 100 years ago. The stock market crashed. It was a really, really bad time for our country. And I mentioned the price to earnings ratio. It's a statistic, okay? Before that crash, it was in the mid-30s. Before the crash in 2000, remember when you had the dot-com bubble and 9/11 and those horrible things occur? The PE ratio was in the mid-30s. Right now, we're in the low to mid-20s. So what I'm trying to explain to you is that stock market bubbles can blow bigger and bigger and bigger, and the best gains for the stock market are at the end of the bubble, when they go almost vertical. If you had invested in the stock market in 1998, 2 years before the crash of 2000, you would have made 35% in 2 years. So the market's going to rip higher before it has trouble. You'll have these corrections, but don't be afraid of the stock market right now. The AI boom is a thing that's going to continue. The bond market, I won't bore you with this too much. When I see the bond market, think of like the CD market. When you go into a bank and get a CD, interest rates had gone down low. You'll see there's like a dip. That's COVID, where you basically, if you went into a bank, you'd get a CD that paid you like, I don't know, 0.5% for 3 years or something ridiculous like that. After COVID and then inflation, interest rates went up. That's why you see this big lift into like this mountainous looking thing here. Now you can go into a bank and get 3-4%, much, much, much better than during COVID. So interest rates are pretty good, and that's something to be aware of. So what do you do about all this? So the takeaways here for investing, if you want a reference, the last time Donald Trump was in office, the stock market had 6 10% drops, but it went up over time during his administration. Very volatile. And we think, because of who he is, that the stock market will continue to be volatile because there's headline risk. He might say something, the market freak out. But at the end of the day, the stock market does well because, again, as I said earlier, the Fed's cutting rates, they're spending more money, there's all these things that are pushing it. So any kind of a drop in the stock market is when you would want to buy. You buy low, sell high, and that's what you want to look at. So we kind of think that we're going to kind of redo the stock market from Trump's first term. Bonds, definitely want to have some bonds. I said earlier, you can get CDs now 3, 4, 5%. Those are good. And the bottom part, I talk about diversification. You want to have money overseas. I can't stress that enough. If you have a 401k, check it tonight or tomorrow. Make sure you have some money international, okay? Because it's doing very well, and we think that will continue. So there you have it. I think that's about the time. Yep, 12:30. So I'm going to pause now. Anybody have any questions? We're glad to answer them. I know I covered a lot. Yeah, it's a very, very good question, and the answer is it has changed. It has changed. So let's talk about that. So right now, we have this government shutdown, right? We have a lot of political instability. We have a lot of contentiousness. We have, issues. I don't want to get into all that. But, and what you've seen and is that gold has done well, okay? Bonds have done okay, but bonds are no longer the safe haven that they once were. They're more stable, but it used to be that you'd sell stocks and buy bonds, okay? Now, if you sell stocks, there's really no place to go except cash. Because right now, bonds, stocks, Bitcoin, gold, silver, it's all going up. And what that is telling us as professional money managers is that inflation is probably going to come back and rear its ugly head. Now, that being said, you can make money in an inflationary environment, which is you want to own, stocks, bonds, gold. Gold, I would own gold. Bitcoin's a different animal. If you want to play in that space, it's fine, but gold to me is a better play than Bitcoin. Ultimately, what you're identifying is that the traditional relationship has kind of broken down. You want to own bonds because they are stable. They're not very volatile, and you'll get 4%, like a CD or something. But you don't want to view it as a safe haven as much as gold is a safe haven. So I think gold is something that a lot of people are adding to their portfolios. China buys a lot of gold every month, okay? These other countries are buying a lot of gold for a reason. The old saying is do what the wealthy are doing. The people that have a lot of money are buying a lot of gold. Owning gold in your investment portfolio is prudent. We usually say 10 to 20% of all the money you have should be in gold or silver. That's higher than normal, and so I would still buy gold. I know it's at 4,000 an ounce today, but it could go to 6. Don't be surprised. Gold will go much higher if inflation is going to come back. And if inflation does come back, stock market will do okay until eventually we may have a bubble. But we're not there yet. I can't stress that enough. The bubble is probably 2 or 3 years off, we think. But it's a great question. The answer to the question is no. It's no longer that same correlation. If I were going to sell something like stocks, I would go buy cash. I wouldn't buy bonds. Because if inflation develops, okay, this is going to get a little complicated, but if inflation develops, you're going to see interest rates go higher and the value of bonds are going to go down. They don't move together. And so when rates go higher, bonds go down. So if you sold stocks to buy bonds, you might lose money there too if inflation is going to go up. The only thing that does well in inflation is gold, basically, in really scary inflationary times. Somebody would say to me, well, everybody's buying gold because the world's going to end. I'm like, no, I don't think that's it. I mean, the world could end, but I'm saying that the reason gold's going up is inflation. Inflation, inflation, inflation. Gold went up and peaked at $800 an ounce in 1980, okay, long before inflation actually ever went away. So gold will lead the way. If gold is going higher, it's because inflation is probably going to come back. And the only way to hang in there is to own gold, ride the wave, right? Because homes are not going to get cheaper, cars are not going to get cheaper, things are going to get more expensive. Here's how I'll answer that. We are advising our clients that when we get later in the decade, you need to probably hunker down a little bit. We think we're in the early stages or the middle stages of this bubble. Okay, we actually think a bubble is developing, but we think the stock market, housing, is going to continue to go higher, unfortunately. We think it's going to be something that many people are frustrated by. I have a daughter, she can't buy a house. She ain't going to be able to buy a house until we have a depression, probably. But the point is, eventually it'll pop, but we don't think we're to that popping point. Does that make sense? So to answer your question, we think housing goes higher, unfortunately, and then eventually we'll have this kind of pop, but we think it's a ways off, 2-3 years. So basically, to answer your question, I would buy a house today, even though it's expensive, because it probably will go up even more in value, believe it or not, before it pops. The thing about bubbles is they're just, how can I say this? If you study history, the stock market it's like a vacuum. It will bring in everybody. Like, I will never forget, it was 1999, and this older woman came into my office. She's like, I want to buy pets.com. And she's like 82 years old. I'm like, why do you want to buy pets.com? And she's like, well, because it goes up. It's gone up every year. It's up, And at that moment, it was a signal that when the grandmother wants to buy pets.com, you see what I'm saying? And we're not there yet. See, no grandma's coming around to me asking to buy NVIDIA. You see? We're still going. And it's not until everybody's, and then it pops, because what a stock market is really good at is causing a lot of pain for a lot of people. I've done this a long time. Trust me, I've made mistakes myself, and it will hurt everybody when it pops. But a lot of people are not in it yet. You see what I'm saying? So I think the stock market will keep going, and then everybody will, oh, I got to get in it, and then boom, it'll go. Another story I have is in 2008 when the market crashed, the housing, I had a guy come in, I felt so bad at the time. He comes in, the stock market's way down. He's like, I got to sell, I don't have any money left. I'm like, you don't want to sell now. I mean, it had already crashed. He's like, I got to get out, I don't have any money. I'm like, well, no, don't do that, okay? And he did. And then, of course, the market stopped and then went up, right? Left him behind. The market moves there's a saying in our industry, the market moves in whatever way causes the most pain. I mean, I tell you, I had a lot of clients that wanted to sell everything they had in April because of what was done by the president. And I explained to them, okay, but how about we do half, not all? And my point is, when you think you've got it right, the market will do the opposite. It's just the way it works. Nobody expected the stock market to be, it's just ripping. Think of it as a baseball game. We're probably in the 4th or 5th inning, okay? And so what's going to happen is we're going to have another move higher, okay, for whatever reason, and then that'll get everybody to get in there, if that makes sense. So if I'm answering your question, you want to be in the stock market. Now, how much you want to be in the stock market is a function of your age, how much risk you want to take. I'm not saying you put all your money in the stock market, but you don't want to not have any in the stock market, right? You know, if you're older, maybe 40, 50% of your money. If you're in your 20s or 30s, you probably want to have 70 to 80% of your money in the stock market. The only thing that's changed is you want to have international stocks and you want to have some gold. Those are two things you want to have. Bitcoin, if you want to play a little bit with that, but that one's a little trickier to figure out where that's going to go. So let me say this about that. I don't think there's a problem with putting a little bit of money in Bitcoin. The way I would do it is there's an ETF. It's pretty easy to remember. It's IBIT. IBIT. So bit, I in the front, IBIT, IBIT. If you buy that, you're in Bitcoin, okay, relatively. I mean, it's an ETF, but short of buying Bitcoin, you're in it, and you'll track it, right? And so I think owning 5%, you know, of Bitcoin is fine. Just don't do gold. Gold, like, do 10 to 20%, you know. And so the answer to the son's question would be to say, well, I'll put a little bit in, but I don't want to put all of it in, you know, because we don't know how it's going to shake out. You know, it's transformative. The people that are on crypto and tokenization, they want to change the whole banking sector and how things operate. And I mean, I can tell you, Wayne, and I'll tell you, it takes the banking industry a long time to change anything. So we're not going to Bitcoin anytime soon. But having a little bit is fine. I would just do gold instead, but Bitcoin. So I wouldn't avoid it. I just wouldn't put a lot in it. Does that make sense? Kind of. Well, I don't think I guess the problem I'm having is I can't say to you that it's a bad investment because it may go higher. There are people that think it'll go to $1 million, you know, and that's 10 times higher than it is now. So you might buy a lottery ticket, buy a little Bitcoin, right? So the younger generation believes in Bitcoin, and they're going to be around longer than we are. So they may get it right. I just wouldn't put too much in it. So I really don't think you should oppose what he says. I just think you want to temper it. I'm like you. I just buy the ETF. It just follows it. It's an easy way to own it. There are ways to actually own Bitcoin and have, you know, credit cards that are tied to. I mean, it's like, whoa. Just if you want to buy enough so that if you put 1,000, it becomes 10,000. Just buy that ETF, IBIT. That's how I do it. But I think it's important not to tell. I just don't think you can say to the youth they're wrong, because so far they've been right. I mean, it was at 10,000, now it's at 100. It could go to $1 million. So T-bills fall under the bond market, okay? And so I like T-bills. The older you are, the more you want to have T-bills. But here's what I would say, okay? Because I think inflation is going to develop again, and we're going to have higher interest rates, I would go short term. I would buy 1 year, 2 year.
I just usually buy like 3 months.
Oh, well, that's really short. Yeah, you could go a year. That, you know, 1 or 2 year T-bill. I wouldn't buy a 10-year. Don't buy a long T-bill or treasury note. Buy a short one because I think interest rates are going to go higher. Okay? Not right away, but 2 or 3 years from now, as we approach the next presidential election, I think interest rates will go a lot higher. So it's a great, great question, and there's a lot of very, very smart people trying to figure out just that. What I will tell you is, so we all know that Russia and China and North Korea, they are buying lots of gold because they're trying to de-link from the United States dollar. They don't want to be what they would call themselves servants of the dollar-denominated world. So they want to create currency between themselves that's like gold. We are obviously in different ways fighting that, behind the scenes, in the scenes, all this stuff. If those countries continue to develop more political prowess in the world and they continue to de-link from the dollar, okay, you're going to see the bond market break. And you're like, well, what does that mean? Well, the bond market breaks when everybody sells American bonds and interest rates go way up. So there's a way to know when it's going to happen. Watch interest rates. What's going to cause that is tough to know, because it's a function of these other countries, right? And who knows what Putin's going to do, or Xi Jinping and all these guys and gals. And so for me, in my business, what I'm going to watch is interest rates. If interest rates start to go a lot higher, I mean like 1, 2, 3% higher, then you know we're coming up to danger zone. Does that make sense? And the system's breaking. And that could lead to this potential crash. But that is, to me, that is not anywhere near right now. I really mean that. I think that's more like 28, 29, ironically, maybe 100 years after the last time. There are some that think about a 100-year cycle is a thing, and so they think we're going to have another crash around 2030. But I don't think we're going to have that right now. I really mean that. Okay, this AI thing is rocket fuel, and AI is going to be more and more used in our country for good and for bad in different ways, and it's not about to stop. So I don't think you're going to need to worry about the dollar yet, but later in the decade, I think you need to watch interest rates. That's your tell that the system is under pressure, and it will probably come out of China and Russia and other countries that they get into their Iran or whoever else they corral, and those countries will be in economic battles with us, basically, to try to de-link from the dollar, basically. I'll give you a couple examples. So the short answer is I would use an ETF. I would use XLK or QQQ. You may have heard of these. Basically, they buy the sector. Here's the reason why. So, right now you've got these fancy names like NVIDIA, ChatGPT, Microsoft, Google. Every time there's a bubble that develops, okay, like there's a famous article in 1926, they said radio stocks are the future. Radio stocks, it's going to change the world. Radio, right? Radio stocks. And of course, they went up higher and then they all crashed and then there were only a few left, right? So what's going to happen is when we get this bubble someday that breaks, there will be a small amount that make it through the carnage of the crash, we'll call it. So what I would say is if you buy XLK or QQQ and own all of them, you'll just kind of ride the wave, and then when you sell it, you could just get out of it in one fell swoop. You see what I'm saying? Because it's hard to know who's going to win this, right? They're all racing, all these tech characters are trying to beat each other, and you know what I mean? It's tough to know. And I'm not smart enough to know which one to win. But I think it's something you want to be in because we think it'll go higher. It's going to keep going higher first before it breaks. ETF is exchange traded fund. It's a fancy term to simply mean it tracks something. So you can buy a gold ETF, you can buy an AI ETF, you can buy a consumer staples ETF, You can buy an energy ETF, and it tracks whatever it's called. So if it's an energy, it tracks energy stocks. If it's gold, it tracks gold. If it's Bitcoin, it tracks Bitcoin. So it's just something, it's a Wall Street invention that tracks something. And the reason I like it is because you can sell it instantaneously on your phone. You know, so if something really bad happens, you can just get out. Boom, you're done. You know, versus having to sell this and then sell that and sell, you know, because if you have a lot of individual stocks, then it gets a little tricky. It's very safe, and the beauty of it is it's extremely liquid. Millions and millions and millions of shares trade on it. It has the share underlying it, so it owns NVIDIA, it owns Microsoft, it owns it owns all this stuff, but it's in one little pile. And because it's liquid, if something weird happens, you can sell it because it's heavily traded, if that makes sense. You know, so that's why I like it. You know, so. The only thing I would like to own too is physical gold. There's value in owning physical gold, but you have to store it, and gold is heavy. That's the problem with gold, because if you haven't held gold, it's heavy. You get a lot of it. Okay, well, good. Well, thanks, everybody. If you have any other questions, feel free to grab me. I'll be around.
Awesome information. Great. Thank you very much. We appreciate it. And hopefully, you know, we're going to work with Winton Woods Schools, because I think that financial literacy like this is something that we need to make sure is some kind of curriculum for everybody, because we don't understand all of, you know, yeah. And I know it's very difficult. I think the 15-year-old could probably read it better than we can if we teach them how to do it early, because I'm like, here we go. So thank you very much. Want to quickly, if you're up for it, or one of you, anybody, if we can give a little bit of a quick update on some things going on especially in the city. I know the mall is our big, big plus. If you got anything that you can, yeah, Chris. If most of you know, and anybody who's not here, but one of the biggest projects in the, I don't know, region, I guess, would be the Forest Fair Mall when it was built, and now it is being redeveloped. So you want to give us a quick update?
Sure. Well, you may have seen, the mall is currently coming down. The demolition started about 2 weeks ago or so, and will continue for some months. That is a very big expense, given the size of the building and the extent of the property, as well as some underlying rocks that on the site, and making it ready for redevelopment. And the cities of Fairfield and Forest Park worked together for about 3 years on this, and put together a deal that with a developer out of Texas called Hillwood, and that's a company that started by Ross Perot's son. That developer is demolishing the buildings, and the other part of this deal was that they removed some municipal bond debt, paid it off, so that that was holding the property back for a lot of people that could have redeveloped it sooner. It kind of made the property upside down in terms of financing. So that is all great news. The plan is to build a large multi-use, it's not a headquarters building. The headquarters is actually on Kemper Meadow, but this is for Hillman Fastener, and local company, Fortune 500 company, and they're going to have a large operations center on the property. That's going to be about 50 acres of the 85 acres of the property. So and that's going to be in the where the Biggs grocery store, if you remember, towards that end of the property. In front, there's going to be about 30 acres left over that both cities are working on developing really a vision for that and what it will be in the future, but we don't know that yet. So, but personally, I've been with the city for 24 years, and we've got Rafik here. He's been in the city for how much longer than that? 35 years. So yeah, I think Rafik was here when it opened. And this has been such a long road that really I felt like in July and August, getting out champagne and celebrating just the fact that it was moving to this milestone. So it's going to be demolition for the rest of the year into the early next year. And then they will start on preparing the site and the construction of the Hillman building. That'll anchor the property, and we'll have some time, some breathing room to work on what's going to happen in front. So.
Great, thank you. Sorry, I put him on the spot. Yeah, because there are a lot of projects going on, but that one being such a big thing. And that was one of the other, the government shutdown, like we said. There's a lot of things that happen federally, but one of the biggest things that I think will affect us, and we'll talk about it a little bit probably in the upcoming months, but they announced, I don't know if it was yesterday or today, that they will be starting construction of the bridge, the big bridge. And we had programs, I know seems like it's far south, but it's gonna make a huge difference for everybody in the area. And that will be, but that's funded, so hopefully they get that going. But I think that the area, and we talked about it, just jobs and things like that in the area for that type of construction is going to be a huge difference, with the economy too. So that's a big thing. And then we do another thing that opened here in northern Hamilton County is fantastic. Is the joint Hamilton County, what do we call it? Is it the Emergency Center and Jobs and Family Services? Aren't you up here? But there is the whole hub. It opened maybe in May. Yeah, and it was warm, and so that is a huge resource for our area in Hamilton County to make sure that it's the Hamilton County Emergency Management, but jobs and family, and isn't there a JFS is here? So that's a big plus for all of our working world. And Peter, do you want to say anything about the library quickly? Sure. Peter Bohr is our kind of our building area here. He's in the library.
So as Nancy said, I'm Peter. I work here at Forest Park Library. I work on a lot of small business projects. We do a lot of education programs here. They're free, and we use a lot of partners, including people in this room, Jermaine and others who've helped us with many, many projects. So if you're an entrepreneur or a small business owner, check out our opportunity space on the glass. There are things that are posted for classes. You can register online, and those things are always free. So this Saturday we have a class from 1 to 3. It's on mobile marketing. So if that's a thing that you're trying to learn or improve on, we can help you with that. The end of the month, on the 25th, we're doing a program called Lessons from Year 1. So if you've launched and you're trying to figure out where you go after year 1, we'll have some partners in the building to help with that one as well. You're in one of our great spaces we have here. This is the meeting room. The whole meeting room, this holds 180 people. So if you're planning events, trainings, programs, you can also divide it in half and get one side holds 70, this one holds 110. We also have meeting study rooms that are smaller that you can use for your office, or smaller meetings if you want to do that as well. And we have a lot of partners in the building too. So again, if you're an entrepreneur and you have questions, Minority Business Assistance Center is on site 2nd and 4th Wednesdays of the month. You can drop in and see Vivian and her team. Or you can also now chat with SBDC. They're in our building on the 3rd Thursday of the month, and you can just drop in and see them from 10:30 to 12:30. So we're here to help. You have any questions, look me up, and I'm happy to give you a hand. Thank you.
With Wynwood Schools, Jeffrey Ryle, and he is going to talk about what we're doing with the schools. Go ahead.
Yeah, so there's two events coming up in October that I thought in particular this group might want to hear about. The first is on Tuesday, October 21st, I think from 9 to 1. Our high school is hosting, speaking of, an AI promptathon, and you're probably thinking, what does that mean? Essentially, this is our third time, I believe, hosting this event, and we ask businesses to bring a problem that they have or a challenge that they have in their business, and then during that morning time, our students will work with you and develop an AI app that will help solve that business problem. And so we've had a number of businesses that have come and walked out the door with something they could use that actually met a problem that they have. Real quick stories that last year there was a person that was from a local business, and they were trying to hire someone that had a specific skill set and specific certification, and they had paid recruiters and weren't getting the candidates that they needed, and so they brought that challenge to our students, and our students developed an algorithm and through AI a way for them to search and searching social media profiles for certain skills or mentions of certain keywords. And so that person actually walked out the door with a handful of names that they said the recruiter didn't even know that person existed. So it's a way for our students to not only practice their critical thinking and design thinking skills, but also a chance for business owners or people in the community to connect with our students. And so that's one thing. That is Tuesday, October 21st. And then on Thursday, October 30th, the district is hosting a movie screening for a movie called Count It Out. And essentially, it's a documentary that talks about the importance of math and learning math and how math plays a part in everyday life in millions of ways that you might not even realize that math is taking place. And so many of us say, well, I'm not a math person. And so this documentary sets out to kind of debunk that concept, is that everyone is a math person, even if you don't want to be, and what are the implications and importance of that. So again, it's a free screening. It's the only one in the Cincinnati area. And so it's Thursday, October 30th at 5:30 in our high school. So again, we invite community and business people to come. The 21st for our promptathon, and the 30th for our movie screening of Count It Out. You can get information about both these things on our website. So, thanks. For Winton Woods High School. Yeah.
And we will,
I have some
yeah, and I'll link that.
flyers I'll leave out here about the screening.
Okay, great. Wonderful. Well, thank you very much. Keep an eye on your chambers, your individual chamber for upcoming information.
At the buzzer. How's everyone doing? Here in the city of Forest Park, we're celebrating Fire Prevention Week through the end of this week, but we celebrate it the entire month and we practice it all year round. This year's focus is on lithium-ion batteries. Lithium-ion batteries are everywhere. Cars, calculators, cell phones. I just want to say, be careful with your batteries, overcharging your phones. Like, who's guilty of keeping their phones plugged in all night? By the bed, inside the bed with them? Bad. Don't do that. Those batteries, if you overcharge them, they can damage them. If they get damaged, they can explode. We've had several fires here in Forest Park due to lithium-ion batteries. We had someone charging a boat battery inside their home and caught the whole backside of their house on fire. So all of this to say, be careful when you're charging. If it gets damaged, if you smell a funky odor coming from the batteries, discard them, or I should say recycle them. If you want, you can contact the fire department, and we can tell you where you can take those batteries to be recycled. They should not be thrown in the trash, because if those contacts touch something metal, something aluminum, they could catch fire that way as well. So with that, that's all I have. Thank you very much.
All right, I think that's all we got. So have a wonderful couple weeks. We probably won't be back as a joint chamber until after the first of the year. But thank you.